The latest unemployment numbers offer a reassuring glimpse into the state of the nation's job market, that delicate equilibrium where neither too many workers are being hired nor too many let go. It's the economic sweet spot that policymakers dream of, even if attaining it means walking a tightrope between the conflicting pressures of inflation and growth. The numbers point to a labor market steadily finding its new balance after the Federal Reserve's aggressive interest rate hikes of the past year. Those increases, totaling a whopping 5.25 percentage points since March 2022, were the central bank's blunt instrument for slowing the overheated demand and rising prices gripping the economy. The strategy seems to be working, albeit gradually. Last week, 215,000 Americans filed new claims for unemployment benefits, according to the Labor Department's latest report. That's a modest dip from the week before, down 8,000 claims. Forecasters had expected a higher number. Such incremental declines are the sort of granular progress that economic statisticians relish, but that others might overlook amidst the cacophony of GDP figures and inflation indexes. To the cultured eye, however, they offer an encouraging portrait of an economy righting itself, with the job market cooling at just the right pace, not too hot, not too cold. This meticulous rebalancing reflects the delicate dance the Federal Reserve is performing. The minutes from its monetary policy meeting in early May, released this week, showed officials assessing that demand and supply in the labor market, on net, were continuing to come into better balance, though at a slower rate. At the same time, conditions overall had generally remained tight. In plain English, that means while some of the frothiness has dissipated from the job scene, it's still an employee's market out there, with ample opportunities and the upper hand in salary negotiations, for now. The central bank's strategy has been a masterclass in gradually taking the air out of an overinflated economic bubble without popping it entirely. That's the hopeful read from these new unemployment numbers, bolstered by the accompanying data on those continuing to receive jobless benefits after their initial claim. That so-called continuing claims figure saw just a tiny uptick, rising by 8,000 to nearly 1.8 million nationwide for the week ending May 11th. Such a marginal increase doesn't set off alarms about companies conducting mass layoffs. Rather, it suggests the job market churn we want to see as the economy cools, some hiring, yes, but some necessary workforce reductions too as overextended companies regain their financial footing. Taken together, the latest figures depict an American workforce trudging steadily toward a new stasis, one better aligned with the supply and demand realities of our hopefully disinflating economy. It's a draining march at times, to be sure, with inevitable casualties along the way. But it beats the alternative of economic freefall. Those in the dismal science see the slowly recalibrating jobs landscape as a vital step, however gradual and granular, toward achieving the fabled soft landing for the broader economy. It's a delicate undertaking, fraught with the risk of overcorrecting by either too much tightening, sparking a severe recession, or too little, perpetuating debilitating inflation. For now, the unemployment numbers hint at Splitsville, between those alternating perils. The Fed's aggressive therapy has started to work its curative effects, suppressing some of the rampant demand that inflamed prices across the economy. At the same time, it hasn't yet gone too far, delivering the sort of hammer blows to employment that could send the nation into an intractable downturn. It's a high-wire act that has required immense dexterity from our central banking elite. By slowing raising borrowing costs, they've incrementally relieved some of the pressures building in the job market without outright rupturing it. The rest of economic waters have been gradually calmed rather than churned into a maelstrom. The still tightening job scene reflects this painstaking execution. It will take many more months of such meticulous rebalancing, more judicious interest rate tweaks, more granular but critical employment adjustments, before the economy conclusively reaches a new stasis. A soft landing is a fragile outcome, easily disrupted by ill-calc policies or unanticipated shocks. For now, though, the unemployment claims offer that most welcome of economic omens, the reassuring prospect of better days ahead, gradually approaching. The nation is steadily advancing toward the longed-for equilibrium, one cautious step at a time. Sound the all clear? Not quite yet. But the latest figures put us miles closer to that aspiration, with the American job market showing its continued, controlled descent from overheated highs. It's the economic rebalancing act we hope for, neither too hot nor too cold, but just right. For the daring equilibrists at the Federal Reserve, evidence of a soft landing gradually taking shape.